5 moves to make this week before the FDIC limit gets cut in half. The FDIC Insurance Fund lost $48 billion in 18 months protecting depositors at Silicon Valley Bank, Signature Bank, and First Republic Bank, and the bill to replenish it is now sitting in front of a Congress that is actively debating whether $250,000 in coverage per depositor is too generous to sustain. There is one proposal currently sitting in the Senate Banking Committee that most financial advisors have not read yet, and what it says about the future of deposit insurance should change how you structure your savings starting this week. By the time we reach move number 3, you will understand exactly what that proposal does to accounts that look protected on paper but are not protected in practice. The FDIC was created in 1933 after 4,000 American banks failed in 3 years and wiped out the savings of 9 million depositors. The coverage limit started at $2,500. It was raised to $5,000, then $10,000, then $100,000 in 1980, and finally to $250,000 in 2008 after Washington Mutual collapsed with $307 billion in assets. That was the last time it moved. But here is what nobody is telling you. The FDIC Deposit Insurance Fund, the actual pool of money that pays you when your bank fails, currently holds $125 billion. American depositors hold $18.6 trillion in insured and uninsured bank accounts combined. That means the fund covers less than 1 cent of every dollar it is supposed to protect. The system works on faith, not reserves, and faith is exactly what Senate Banking Committee Chairman Tim Scott said in March 2026 was being actively reconsidered. Therefore, this is not a theoretical risk. This is a structural problem with active legislative attention and a window that is closing. Here are the 5 moves to make before that window shuts. Move 1. Spread your deposits across multiple institutions right now. The $250,000 FDIC limit applies per depositor, per institution, per account category. That last part is what most people miss entirely. If you have a checking account and a savings account at the same bank under the same name, they are not separately insured. They are combined and measured against the single $250,000 limit. The only way to get separate coverage at the same bank is through different ownership categories, joint accounts, retirement accounts, and payable on death designations, each of which carries its own $250,000 limit. But the simplest and most bulletproof move is to spread your deposits across multiple banks so that no single institution holds more than $250,000 of your money in any single ownership category. If you have $400,000 in savings, $250,000 goes to Bank A and $150,000 goes to Bank B. Both amounts are fully insured under current rules. The reason this matters right now, this week, is the proposal in the Senate Banking Committee. The framework being discussed would restructure FDIC coverage to prioritize business accounts and payroll accounts at the expense of personal savings accounts above $100,000. If that framework passes in any form close to what is currently written, personal depositors with balances between $100,000 and $250,000 could find their effective coverage cut by 60% overnight. Spreading your deposits takes 1 afternoon and costs nothing. Log into your current bank. Calculate your total balances by ownership category. Open a second account at a different FDIC-insured institution for anything above $150,000. Do not wait to see how the legislation lands. By the time it passes, the window for easy repositioning will already be closed. Therefore, your deposit exposure is now distributed. But move number 2 takes your excess cash completely outside the banking system without giving up a single dollar of return. Move 2. Open a Treasury direct account and move excess cash into T-bills. Treasury bills are not bank deposits. They are direct obligations of the United States government, and they are not subject to FDIC limits, banking system failures, or deposit insurance restructuring of any kind. When you hold a Treasury bill, you hold a legal claim against the U.S. government itself. The only scenario in which that claim fails is the same scenario in which the FDIC itself fails, because the FDIC is also a U.S. government agency backed by the same full faith and credit guarantee. The current yield on 4-week Treasury bills as of May 2026 is 4.32%. The current yield on 13-week Treasury bills is 4.28%. Both rates are higher than the national average savings account rate of 0.46% and competitive with the best high-yield savings accounts on the market. TreasuryDirect.gov is the U.S. government's direct purchase platform. No broker, no intermediary, no annual fee. You link your checking account, verify your identity, and you can purchase Treasury bills in minimums of $100. The account setup takes approximately 15 minutes. Your first purchase settles in 2 business days. The FOMO calculation here is specific. If you hold $100,000 in a Chase savings account at 0.01%, you earn $10 per year. If you move that same $100,000 into 13-week Treasury bills at 4.28%, you earn $4,280 per year. That is $4,270 in annual income you are currently leaving on the table every single year you stay at Chase. And unlike a savings account, T-bills are completely outside the reach of any FDIC restructuring proposal in Congress. Therefore, your excess cash is now in the safest instrument in the world, earning 4 times what your bank pays. But the third move protects a category of savings that most people assume is already safe but is not. Move 3. Understand what your brokerage account actually covers. Here is the piece of information that the Senate Banking Committee proposal specifically targets and that most Americans do not know. Brokerage accounts are not covered by FDIC insurance. They are covered by SIPC, the Securities Investor Protection Corporation, which is a completely different system with completely different rules, and a coverage limit of $500,000 per customer, of which $250,000 can be cash. But SIPC does not protect you against investment losses. It only protects you against broker failure. If your broker goes bankrupt and your account holds stocks, bonds, or ETFs, SIPC steps in to return your securities. If those securities have lost value in the market, SIPC does not make you whole on the loss. It only returns what is there. The move here is specific. Any cash sitting idle in your brokerage account in a money market sweep fund is not earning what it could earn and is not protected the way you think it is. Most brokerage cash sweeps pay between 0.01% and 0.5% on idle cash. Move that cash into a Treasury money market fund or buy short-duration Treasury ETFs directly inside your brokerage account. Fidelity's FDLXX Treasury Money Market Fund currently yields 4.2% and holds only U.S. Treasury obligations. Schwab's SNSXX yields 4.18%. Vanguard's VUSXX yields 4.24%. All three are available inside standard brokerage accounts, require no minimum hold period, and settle same day. Your cash works harder, stays liquid, and sits in treasuries instead of a bank sweep that may be affected by FDIC restructuring. Therefore, your brokerage cash is now working at 4 times the rate with zero additional risk. But move number 4 has a deadline that does not move and that most people will miss because they do not know it exists. Move 4. Max your I-bond purchase before the June 1st rate reset. The U.S. Treasury resets I-bond interest rates on May 1st and November 1st every year. The current rate is 4.28%. After June 1st, the new rate based on the March Consumer Price Index calculation drops to 3.1%. That 1.18% difference on $10,000 is $118 in guaranteed annual interest that disappears permanently for anyone who waits past June 1st. It does not come back. The rate you lock in at purchase is the rate you carry for your first 6 months regardless of what happens to future resets. I-bonds are also completely outside the banking system. They are direct obligations of the United States Treasury. They cannot be seized in a bank failure. They cannot be affected by FDIC restructuring. They earn interest that adjusts with inflation, which means if inflation spikes in Q3 or Q4 of 2026 as energy prices respond to the Middle East supply disruption, your I-bond rate moves up with it automatically. No CD, no savings account, and no money market fund offers that combination of inflation indexing, government backing, and tax deferral simultaneously. The purchase limit is $10,000 per Social Security number per calendar year. If you are married, that is $20,000 before June. First, at the higher rate. If you have adult children, they can each purchase $10,000 as well. A family of 4 can lock $40,000 into the higher rate before the window closes in 25 days. Go to treasurydirect.gov tonight. The account setup takes 12 minutes. You have 25 days. That is not a long window, and the rate reset date does not negotiate. Therefore, your inflation index savings are locked in before the rate drops. But the fifth move is the one that makes every other move on this list sustainable when the system actually breaks down. Move 5. Build a physical cash reserve outside the banking system. In March 2023, Silicon Valley Bank collapsed on a Friday. By Monday morning, the FDIC had intervened and deposits were protected. But the 48 hours between Friday afternoon and Monday morning was the window in which businesses could not make payroll, individuals could not access funds, and the Ishizai system demonstrated that even a protected depositor can be locked out of their money during the resolution process. The Senate Banking Committee proposal being discussed in May 2026 includes a provision that would extend the resolution window for personal accounts above $100,000 from 48 hours to up to 5 business days during a systemic banking event. 5 business days is a full work week with no access to your money, even if it is ultimately insured. A physical cash reserve of 1 to 3 months of essential expenses held outside the banking system is not a conspiracy theory. It is a liquidity buffer against a system that has already demonstrated a 48-hour lockout window and is now discussing extending it. Essential expenses only: rent or mortgage, utilities, food, and transportation for 1 month minimum. Keep it in a fireproof safe, not a safe deposit box. Safe deposit boxes are inside bank branches and are inaccessible during bank closures. A fireproof home safe costs between $70 and $150 at any hardware store and pays for itself the first time you need it. The amount does not need to be large. 1 month of essential expenses for the average American household is approximately $3,000 to $4,000. That is the buffer between a 48-hour banking lockout and a financial emergency. The 5 moves are spreading deposits across multiple FDIC-insured institutions, so no account exceeds the current coverage limit, opening a Treasury Direct account and moving excess cash into T-bills at 4.28%, repositioning idle brokerage cash into Treasury money market funds earning 4 times the bank sweep rate, purchasing I-bonds before the June 1st rate reset drops the yield by 1.18%, and building a physical cash reserve of 1 to 3 months of essential expenses in a fireproof safe outside the banking system. The Senate Banking Committee vote on the Deposit Insurance Restructuring Framework is scheduled for the week of June 9th. That is 33 days from today. Every move on this list can be completed this week. None of them require a financial advisor, none of them cost a fee, and every single one of them positions you ahead of the people who will wait until the vote is announced to start moving. Open treasurydirect.gov tonight. Pull up your bank balances and calculate your exposure. Order the safe tomorrow.